Medpace released their earnings and they are down 12% today. The year-to-date performance is minus 24%. So in this video, we're going to cover the earnings of Medpace to understand what went wrong, why the market is declining, and if it can be a good opportunity right now for this business. So we'll have a look at the valuation. So first thing we're going to discuss is the growth, and you can see that year to year, okay, from Q1 2024 to Q1 2025, they had some growth, okay, 9.3% revenue growth, okay, but that's pretty old. You have more employees, but then where it became problematic is this. New net business award decreasing by 18% from Q1 last year. A net book bill, okay, same decrease. Ending backlog decreased by 2%. So the backlog is something very important. It's the contract that they are getting. Backlog conversion rate, this got higher. Okay, this is good, but the problem is when you don't have a lot of backlog demand and so on, even if you have a good conversion rate, it doesn't change anything. When it comes to the EBITDA, you have a little growth. The net income, you have 11% growth. So how come a company with net income growth of 11% declined that much? And you will understand here. It's because the net income grows mainly due to less income tax provision than Q1 2024. If we go here and you look at the income before income tax and income tax provision, you can see that they had 22% margin in 2024 and 21% margin this year. Okay, 2024 was 112 million, here 118. But the income tax provision is 3.6 this year compared to 10.2 last year for the Q1. So the net income really, the increase in the net income is mainly due to this lower income tax provision. If you subtract it, so it's around, you remove 7 million, okay? If you remove 7 million from here, you will have way less. It will be way less growth. So you will have approximately the same margin, a bit less. So this is where the problem is coming. They have decreasing revenue, I mean not revenue, but decreasing net income here, not like compared to what they could have, compared what was wanted. And that's the reason, because yeah, if you remove this, you could say, oh, it's fine, we have 11% growth, but that's not the case. When you look at the backlog, here you can see a decrease since 2023. So they didn't manage to come back up. Okay, they have a good conversion rate, but they don't manage to go back up. The net new business award is same, is decreasing since 2024. So that's where you have some problem here for the net income tax. The second one, it's in the margin, okay? Now we saw the growth, let's look at the margins. The EBITDA margin went from 22.6% to 21.2%, so less margin. The net margin from 20.07 to 20.5%, but again, the net margin is not really accurate because of this tax thing. It will be approximately the same. And the operating margin went from 20.4 to 20.3. So we have decreasing margin. Here, don't get wrong, it's still higher than competition. Okay, it's still way higher than competition, but the market seems to be disappointed by this and by the backlogs. Due to higher cost everywhere, okay, and especially in selling, general and administrative, 31.3% compared to Q1 2024. Okay, it's 31% higher. So this is why operating margin are not really good. They have some, I'm not saying issues here, but they spend a lot of money here. When it comes to capital allocation, they did 389 million buyback in Q1, so it's very good. They're doing buybacks, and they got approved for 1 billion increase for the buyback program. 1 billion, okay, for 2025 increase. It's more than 10% of the market cap. So if they do this full buybacks here, they probably will buy back this year more than 10% of the market cap, which is amazing, especially at this price, and especially considering the potential that it can have. There is, however, one thing in the capital allocation that I don't find particularly well. I don't understand it either. So I hope they will ask it during the conference call. Okay, I need to listen to it, but it's the stock-based compensation expense. It's abnormally high compared to last year. Okay, last year at this point it was 4 billion. This is 16. 4 million. This is 16. Like, I don't really understand why it's so high, because if you look at the history for this company, for Medpace, quarterly, you can see that 16 million never happened. In September 2024, you had 11 million, but 16 million don't really tend to happen. So why? And will they do way less after? Okay, maybe they decided that now it's a good time to do it, and after we'll do less. I don't know. But this is something that I don't really like, and need to be, you need to go deeper in this to understand what happened here, because it's not normal that they do that much stock-based compensation. Okay, so here I'm just trying to find out why the stock declined that much. From the guidance, okay, the revenue is expected between 2.1 billion and 2.2 billion. Okay, it's up from a little up. Okay, growth rate between 1.5 and 6.2% for 2025. Net income from 378 million to 402 million. Is approximately the same as the last report, last quarter. So it will be a decline in net income between 6.5% and 0.6%. And the earning per share between 12.26 to $13.04. It's up from last report, which was 11.93 to 12.69. So it will be between a 3% decrease or 3% increase year to year. So we will see here. But let's say that if they do this 1 billion of share purchases, like as it planned, this can be good. Like you may see this plus 3% or even plus 5% if they do this buyback program, and if they don't decline too much in revenue. Generally, they are beating the estimate. They are as well doing better than the guidance. So the guidance should be good. That's a good point, but yet, like, we'll see with this buyback. This buyback may change the thing for the EPS, so it may be something good, especially if they buy a lot of share at this price. We'll check at the valuation now. The stock is around $258, something like this. Yeah, now 253, 264. Okay, so you see the volatility during the video. So we'll put 265. Okay. The last earning, the next earning is supposed to be around 385 if we grow by 7%. Okay, 385 million. You see, I took a very low. They plan 378 to 402 million. So I will put 385 like this. We're more safe. I prefer to take more margin of safety than less. We'll have a growth rate of 7%, 5% buybacks per year for the next 5 years, and a PE ratio of 20, which is the lowest in the last 10 years for this company. You will do 11% per year. If you want to do 13% per year, you need to buy around $250. So around $250 seems to be a fair price. Historically, this company have grown more than 7%. When you compare to competitors, they all plan to grow the same pace approximately. So it seems that there is a global market for this, for CRO, which is a bit less fast in terms of growing, but maybe Medpace, considering that they have a good moat and so on, will be able to grow faster. We don't know. Let's imagine that they grow by 9%. The fair value will be around $271. So we're really around a fair value. So if you think it's a good company, it may start to be interesting to enter at this price. Okay, to enter around here. It sounds like a value which can be good. We will see how it goes, but yet, yeah, 265 seems like kind of fair if you like the business, of course. If you don't really like it or you're unsure, like, study it deeper, because if you're unsure, it's better to just leave.